In the next few minutes, I'm going to show you exactly why Bitcoin dropped, what the data says happens next, and a simple framework you can use to decide, calmly, not emotionally, whether this is a moment to buy or a moment to walk away. But here's the part almost nobody is talking about right now. What if the reason everyone's blaming for this crash isn't actually the main reason at all? And what if the one number that predicted every single Bitcoin bottom in the last decade is sitting at a level right now that most people haven't even looked at? Stick around, because by the end of this video, you'll understand this crash better than most people trading through it. Hey, welcome back to Gigi Invests, the channel where we break down what's actually happening with your money, calmly and without the hype. If you want more videos like this explained clearly, hit subscribe before we get into it. Section 1. What actually caused this drop? Let's start with what's real. Bitcoin has fallen more than 50% from its peak. That sounds dramatic, but the why matters more than the number. There are 4 forces working together here, and understanding each one changes how you should feel about it. First, capital is rotating. When investors get nervous, money moves out of higher risk assets and into safer places: cash, bonds, and government debt. At the same time, a huge amount of investment capital has been pulled toward artificial intelligence infrastructure and semiconductor companies, which are currently offering clearer, faster growth stories than crypto. That's not a Bitcoin problem specifically. It's a competition for capital problem. Second, the ETF structure works both ways. When Bitcoin ETFs see inflows, fund managers buy real Bitcoin to back those shares, which pushes the price up. But when investors pull money out, those same funds are forced to sell Bitcoin to meet redemptions, which pushes the price down just as mechanically. It's not emotional. It's structural. Third, large holders, often called whales, have been selling in meaningful volume. When wallets holding tens of thousands of coins start moving, smaller holders often follow out of fear, even without new information. Fourth, and this is the one people miss, previous rallies were fueled by a wave of new institutional buyers, new products, and optimistic legislation. Much of that news cycle has already played out. Without fresh catalysts, there's less new demand to absorb the selling. None of this proves Bitcoin is broken. It also doesn't prove it's about to recover. It proves the drop has identifiable mechanical causes, not just fear for fear's sake. But there's a bigger question sitting underneath all of this, and it's the one most finance channels avoid answering directly. Section 2. Is Bitcoin actually worth anything? Let's address it head on, because it's the most common argument you'll see in any comment section. Is Bitcoin just a Ponzi scheme with no real use case? Here's a fair, honest answer. Bitcoin doesn't generate cash flow. It doesn't pay a dividend. It doesn't produce anything. In that sense, it's fundamentally different from a stock or a bond, and comparing it directly to those assets is misleading. What Bitcoin does have is a fixed, mathematically capped supply, a decentralized network that isn't controlled by any single government or company, and roughly 15 years of continuous operation without being shut down or successfully hacked at the protocol level. That doesn't automatically make it a good investment. It makes it a scarce digital asset whose value depends entirely on whether enough people, companies, and institutions continue believing it's worth holding. That's not that different from gold, which also has no cash flow and derives its value largely from collective belief and scarcity. The honest takeaway: Bitcoin isn't a Ponzi scheme in the legal sense, because there's no central operator promising fixed returns. But it is a purely sentiment-driven asset, and treating it as a guaranteed store of value is a mistake. That distinction matters more than picking a side in an online argument. If this kind of straight talk breakdown is useful to you, make sure you're subscribed. We do this for every major market move. Now, here's where it gets genuinely useful, because history has actually given us a pattern for spotting real bottoms, and it's simpler than you'd think. Section 3. What history actually shows. Bitcoin has crashed hard multiple times in its history, often by 50% to over 80%, and each time the market eventually recovered and moved to new highs. That pattern alone isn't a guarantee, but it's also not something to ignore. One of the most useful tools for identifying a real bottom is something called the realized price. Essentially, the average price the entire market has actually paid for their Bitcoin. Historically, when the market price falls below this level, it has often marked periods of maximum pessimism right before previous recoveries began. Right now, only a minority of Bitcoin holders are sitting on unrealized profits, a level similar to previous major bear market lows. That's meaningful, but it's not proof of a bottom. Markets can stay irrational and keep falling well past what looks cheap on paper. Professional forecasts are split. Some firms see a bottom forming within the next few months. Others believe prices could fall further before any real recovery. Respected long-term investors also disagree sharply. Some call Bitcoin worthless. Others still forecast prices far above today's levels within this decade. When experts this experienced disagree this much, that's your signal that certainty isn't available right now, no matter how confidently anyone talks online. So if even the experts can't agree, how are you supposed to actually decide what to do with your own money? That's exactly what we're covering next. Section 4. A real framework. Buy the dip or walk away. Here's a practical way to think about this without needing to predict the future. First, only consider buying with money you could genuinely afford to lose completely. Not money for rent, not emergency savings. Money that, if it went to zero, wouldn't change your life. Second, size your position so the swings don't control your emotions. If a 50% drop would cause you to panic sell, you already own too much. Third, avoid making decisions based on how you feel in the moment. Extreme excitement and extreme fear are both signals to slow down, not speed up. Fourth, if you do choose to buy, consider doing it gradually over time rather than all at once. This removes the pressure of trying to perfectly time a bottom that even professional analysts can't agree on. And finally, understand that buying the dip isn't a guaranteed win. Assets can stay depressed for years or continue falling further before any recovery happens, if one happens at all. This isn't a recommendation to buy or sell anything specific. It's a way to make the decision calmly, based on your own financial situation, instead of reacting to headlines or comment sections. So, is this a buying opportunity or a warning sign? Honestly, nobody can tell you that with certainty, and anyone who claims they can is guessing just like everyone else. What you can control is how much risk you're comfortable taking and how calmly you make that decision. If you found this useful, subscribe to Gigi Invests for more breakdowns like this. No hype, no panic, just the data. See you in the next one.